Welcome back, traders. We have Josh Belanger on the line. He is the founder of Option Sizzle. Josh, thank you for joining us. How are you doing today?
Well, good morning, and I'm doing great. And how about yourself?
Great, great. It's a little cold in Detroit, but we're doing well. So, to get started, tell me how you prepared and traded the open yesterday. Back, traders. We have Josh Belanger on
Well,
the line. He
I
is the
dropped my pen
founder
there.
of Option
The Open didn't really do too much. My approach, I'm not very active, especially in the morning, and I look to do a little bit more uh, swing trading approach. So the Open, surprising, and I'm excited about that little bit of an open or that drawdown. I have my
Yeah, you gotta kill the show, just like
I
when.
got to kill that.
Yeah, just like when I call in like to the radio stations on my way into work, they're like,
I did the rookie mistake there.
yeah, kill your radio. Who wants to hear you twice, right?
Yeah, I'm so excited, so excited. Well, so going back to the Open, um, I guess when you look back at the overall day, you're kind of like, wow, once again. I mean, that's how my feeling is because I was excited about the push lower and have been looking for that. So uh, that for me, I was kind of that's my positioning and how my position is going into it is I'm overall I have delta short, and so having yesterday kind of a little bit of a follow through, I was kind of excited, but then for it to reverse like that didn't leave me too excited at the end of the day.
So, are you going to play the January effect coming into the new year?
No, that's I don't kind of buy into that kind of stuff. In I look at it. I try to look at things objectively, and it's. I mean, if I was managing other people's money at this point, there's no way that I would be putting money to work at this juncture. Now, money managers, their agenda is much different because that's how they get paid. But if I'm looking to be strategic at this point, there's just no way. And I've missed a big portion of this. Um, but it just value wise, and it's just hard for me to put real money to work and the risk that I feel is at this point to the downside and limited to the upside.
Okay, Josh. So we got to get a little bit more what's in your wheelhouse here, and do you want to talk about some of the positions that you currently have on, and maybe if not the exact stocks, but the sectors and how you're managing them.
Well, I think the one thing, and if we're going back to what we're talking about, the open and just everything in general, I really just the outlook that I have is overall volatility in the marketplace coming back. We had a little bit of a glimpse of that, um, kind of going back into late middle October, and then it just kind of collapsed from there. And then from there, it's just been very stagnant. So my positioning and my thought process is that we will see volatility come into the marketplace. And a few things that I have on VXX, it's not the best, especially short term wise, because it's a note that's focused on the front month, so it's got a drag. So especially when the market has been climbing higher and it has gone to new highs, that VXX um, is an ETN. It has been pretty beat up from there. So one of the positions I have on there is a short put spread. I actually have a few, one in December, one in January. So 2 days ago, we started to see a little bit of a move there. That's a little bit more of the excitement. I do have a few upside call spreads in that as well, but that's purely directional on the aspect of that volatility cycles in the marketplace and not so directional on the overall market because um, let's say if I wanted to go directionally with a put spread, like in the SPY, I would do something typically in February or March at this time because I want to make sure that I have enough time on my side to get a little bit of a move because moves to the downside happen a lot faster than they do to the upside.
Okay, so do you try and are you from what it sounds like you try and be like market neutral. Is that correct?
No, if I'm market neutral, then my deltas are zero. So
Okay.
my bias is lower. So I have negative delta. So my positions are typically short, at this, typically short with structured plays as that. Overall, as well, I have different volatility plays on different individual stocks that I play. So strangles, straddles, um, and sometimes if I'm taking a directional approach, I'm using a calendar to sell something close to current and then buying something further away.
Short the market or short volatility?
My overall, well, sh- I'm delta wise, I'm directional to the downside.
Okay.
Different volatility different volatility and underlyings are different. So the volatility, some of those plays, I'm trying to play a collapse in volatility, while in the VXX, I'm playing a volatility move for that to go higher. So the volatility in the VXX or the VIX is somewhat biased on the fact of I'm biased on the market as moving lower, but maybe the time that I have is wrong. And betting on the volatility increasing at some point using those products creates a higher probability of success than being directionally with the SPX or the IWM and buying a put spread in there or buying a put. That
So
makes sense.
yeah, I mean,
Should make sense.
basically, basically, what you're saying is that yeah, you think you're right over the course of time, but if the market sits still, it goes nowhere, or maybe just up a little or down a little, you want to get paid.
Yeah, so the fact is I have been wrong a lot over the years, and that happens. So what I try to do is I try to structure plays or structure positions where that it's not totally based on my belief or what I think. It's going to give me opportunities for success. So being that volatility or just volatility in general cycles in the marketplace and in underlyings and in the market as whole, my play is that the VIX, even if I'm wrong, volatility should have a pop higher, should have a cycle higher a little bit, and that's why the direction. That's why a little bit of the play with the short premium or short the put spread and a little bit long the call spread in the VXX.
Okay, just a couple issues here to take a look at. First, Apple AAPL. If you could just give us a short-term outlook here, nice rally in the market yesterday after a lower open. Is this something you have a position on?
This is I had a short strangle on this from before that I took off, and being we had a little bit of a move in volatility. I'd actually look to put that back on again. So for directionally wise, you're a lot of times you're not going to get direction from me. So a lot of times I'm looking at maybe a strangle straddle. The only times I really play direction is when I have an emphasis on direction. And for instance, like last night, KKD went into earnings, and we've talked about this last time I was on. But using unusual option activity, which is a kind of a buzzword for a lot of people, it takes experience to know how to exactly know what you're looking for. But late in the day, December calls were being bought up, and with the open interest and what the volume was and the transparency of those calls being traded on the offer, it's very clear that these calls were probably being bought. So they're buying late in the day, 20 minutes, 15 minutes into the close, and they're buying the 22 and a half strike, I believe. Now, the priced in move of that stock is 20, or the priced in move of that underlying was about $2 going into those earnings, with December being the highest month of implied volatility because that's that was the contract that was only available was December. Sometimes the weeklies are more active and underlyings that have the weeklies that have the higher implied volatility. So with that one, that would be a little bit more of a directional bias I would take because I would say I'm following the money essentially, and those are short term plays where I'm looking to play that. That would be something I actually would sell a calendar on. So we talked about calendars earlier, and the reason why is because I'm selling that volatility and buying something in January that would offset it in case, for instance, looking at KKD, whoever bought those calls didn't get it what it planned out to be, or maybe they were trying to hedge a position. It looked to be a little bit more directionally with out of the money calls. So those are factors of again where I try to use volatility to help me either benefit a position or offset a position.
Josh, I was taking a look at your website here and I wanted to get your opinion. What are the five worst decisions you can make when trading options?
The five worst ones. Well, the first one is always trying to pick direction. And that's not on there, but it goes into the situation where a lot of people don't understand fully how to leverage options successfully. So a lot of times I'll hear people that only buy options, and that's kind of the worst way to go about using options. Just only buying them, because not understanding volatility is really an aspect that everyone, whoever trades options, should be aware of. So not knowing where implied volatility is, like if you look at Apple, which we talked about and I kind of dodged away from a little bit, but uh, Apple overall, I would say, I think it just it's been on a run. I just, again, I would be neutral here, and that's why when I had the strangle on, or that's why my position was like that, because it was more of just taking a factor of the implied volatility. The other aspects that I've noticed that people that make worse decisions trading options is, one, they just buy options. Two, they don't sell options with it. So some of them only just sell options, and they're not, again, condescending of where implied volatility is at, and looking at where the opportunities exist. So a lot of times people will come to me and say, "Hey, Josh, I've sold options and I've gotten steamrolled." It's kind of a buzzword they like to use. And a lot of times they're not familiar with, well, that same, even if you sell options and the implied volatility is low, well, you're taking on risk that you would have gotten paid more if implied volatility is high. Even though it's a high probability trade, it's more successful when you are taking on risk that is more expensive and you're selling that higher implied volatility. And we have an article that comes out every week. This week I'm going to be talking about 150,000 loss, or $150,000 loss, which was two trades when I was managing money. What I learned from them over the time. That was actually one of the things that happened in one of the trades, is that um, I was selling low implied volatility, which led me into getting into a snowball effect of a position that help pass things along and draw down.
Okay, we've had Josh Belanger on the line. He is the founder of Options Sizzle. Josh, thank you so much for joining us this morning. We really appreciate it. Have a good trading day, and we'll have to bring you back on after the new year.
I appreciate it, and I will talk to you soon.
Thanks, Josh.